The market has been consumed with this latest slide in stocks, with the drop resulting in a quick give-up of all the January gains that had pushed U.S. equities to another record high. It's becoming increasingly evident that investors are finally waking up to the risks associated with monetary policy normalizations that are now less capable of being sensitive to any strain in the global economy, given tools that have been exhausted and signs of rising inflation. This is a recipe that unsurprisingly has resulted in a risk liquidation as investors head for the exits in reaction to the outlook, which makes equity market valuations far less attractive as rates move up. The US dollar has benefited from this flow as well. Last week's Fed message that it would be expecting inflation to pick up in 2018, coupled with a rise in US hourly earnings, have been driving some dollar demand, though currency traders are a little more tentative buying dollars with the US administration's soft dollar policy hanging over their heads. Right now, the question seems to be whether a combination of more aggressive Fed rate hike timeline and risk-off flow are enough to offset the US dollar bearishness from soft dollar policy. Earlier today, the RBA left policy on hold as was widely expected, with the Australian dollar underperforming ahead of the event risk on the back of softer retail sales and trade. Looking ahead, key standouts on today's calendar include German factory orders, a speech from Bundesbank Weidmann, Eurozone retail PMIs, updates relating to German Grand Coalition negotiations, US trade data, US JOLTS job openings, Canada trade and IV PMIs, and the New Zealand GDT auction. That's all for now.